Imagine making £40,000 in profit from your properties and then handing £16,000 of it straight to the taxman. For many landlords, that's reality. And once your income tips over £100,000, things only get worse. You lose your personal allowance, you lose some childcare benefits, and every extra pound becomes brutally expensive. But it doesn't have to be that way. There are completely legal ways to bring that tax bill down to zero. I recently sat down with Nadeem Raziq, a chartered accountant and head of tax at Provestor who works with property investors every single day, helping them keep more of what they earn. And in this video, we're going to show you why higher rate landlords are hit so hard and the legal steps you can take to cut that bill right down, even potentially to zero. So Nadeem, sketch out the situation that our hypothetical person finds themselves in to start with.
Yeah, so this is a real common example and actually a case where someone may well be earning sort of around £60,000. So just pretty much in the high rate threshold, paying tax at 40% on their employment or self-employment income. And then they have property income and property profit of, let's say, £40,000. And as we've discussed before, that £40,000 is their taxable profit because remember, we can't deduct their mortgage interest restriction. So the taxable value of their profits is the full 40,000. So we're in a position where someone's earning £100,000 in total, and we want to see what we can do in terms of mitigating potentially tax on that property profit. So as it stands, you're a high rate earner on that property income profit of 40,000, and that would be at 40%. So you're paying circa £16,000 on tax on just your profit on your properties.
And then, great news, they managed to go and negotiate a new job, earning an extra £10,000. Amazing. But not, because although earning over £100,000 a year sounds like an aspirational thing, it's something that people really try not to do, although that sounds strange. Break that down.
No one's going to say no to a pay increase or a new job or a bonus that's going to sort of increase their wage. And ultimately, that also deductible through PAYE. So there's no sort of magic wand that they can do to make that massively decrease in terms from a tax exposure point of view, unless they have things like a salary sacrifice and they can reduce their gross income somewhat. But it's a real common question we get from landlords because what's ultimately kept them sort of just in that safe zone of below the £100,000 threshold, all of a sudden now they've got this increase in pay or a bonus plus the £40,000 in property income, which hasn't gone away. That's stayed pretty steady, or likely to increase potentially if you increase your rent year on year. So we're now in a position where effectively you've gone over that £100,000 threshold per annum, and as you quite rightly said, it kind of puts a lot of people off because for every pound you will go over the £100,000, you lose £2 of your personal allowance. So that's your tax-free £12,570 tax-free allowance. So you can see for every pound you go over, it starts getting really expensive. So by the time you get close to £125,000 of gross income, you've lost completely your £12,500 tax-free allowance, which basically costs you another £4,000 or £5,000 in tax because that's what you've eroded away in tax-free savings. And then the magic figure of 125 pushes you into the next threshold of 45% in terms of income tax as well. So that gets you into another realm of tax bizarreness. So the £100,000 is really important, and people try to keep below that if they can in some capacity.
By the way, if you want to go deeper on this, we've put together a £100 million property toolkit. It's completely free, and inside you'll find the exact checklists, calculators and templates that investors use to scale portfolios the smart way. Grab it now using the link below. So the properties are the lever we can actually pull. The obvious thought is shove everything into a company and be done with it. But before we do that, let's look at the real costs of that move and why it can brutally hurt your cash flow on day one.
From a tax planning point of view, it could well be recommended that these properties are better had in a limited company as opposed to your personal name, where obviously it's pushing you to that 100,000, 40% threshold. And, one default option could be to just move that portfolio of properties into a limited company. Which is an option. And what we've got to remember, a limited company, although it belongs to you, is a separate legal entity. So as far as transferring those properties are concerned, it is a market arm's length transaction. And what that means is effectively capital gains tax is chargeable as well as stamp duty. Now, because you are the seller and the buyer, that's a double tax hit on you. And that could be quite material. It could be quite considerable. So there might be some number crunching involved there in terms of working out what that's going to look like, because that's a short-term cost. Remember that capital gains tax is due within 60 days. Stamp duties are due within 30 days. So it's a potential big outlay at the outset. Now, it could well be that actually in the long term, it still works out in your favour because you've now pushed that £40,000 into a company which is paying tax in a more efficient manner, great. And it's got you out that 40%. But we need to then balance that with actually how much that's going to actually typically cost now from day one to get that moved across. And this is when we talk about how emotionally attached you are to properties, how important is that those properties remain in your portfolio. Because if you were a bit 50-50 as to whether you wanted to really keep these properties anyway, and they were just, they were doing the job as it was, then not something I'd recommend, because you're going to be putting a big outlay just to move it into the limited company to eventually sell in the short term. But if it's something that you really want to keep and you're keen to keep those, then it's worth doing those calculations, bit of a number crunching exercise, just to work out whether it's worthwhile.
Short-term pain for long-term gain can be fine, but most people would rather have relief now. So if you want to keep the properties and cut the tax bill this year, you can start with something simple that shares the income differently. A deed of trust.
Well, there are options in terms of what you can do to sort of dilute some of that £40,000 profit away. Common things that we suggest is potentially a deed of trust. Now, a deed of trust allows you to effectively change the beneficial owner of that property, and therefore the profits that you're actually receiving from that property can be split between you and, let's say, a spouse, for example. And that could be 50-50, that could be 99-1, depending on what your spouse's tax brackets are and their tax position is. These are just really common historically for people when it came to selling properties, because when it came to selling properties, people didn't really want to pay a huge amount of capital gains tax, and there was a £12,500 tax-free allowance for, say, their spouse that they wanted to really utilise. So a lot of people used to put a deed of trust in just before completion and take the benefit of that. However, now, because of things like mortgage interest reliefs and things like income shifting, actually they become much more beneficial to have in place in just terms of planning, in terms of family planning. So if you have a spouse who is a basic rate or a low rate earner and you want them to absorb some of that £40,000, a deed of trust is a great way to allow them to take some of that profit. So if they may be a basic rate earner, allow them to absorb some of the income as well. And of course, if they're a basic rate earner, they're only at 20%. So you can see significantly the tax savings from 40 down to 20, and indeed even from 45 down to 20 that could be had.
So we started with a £16,000 property tax bill. Where can the deed of trust get us to?
Classic example I've given you, 50-50, which is a common approach to take between husband and wife. We're in a position where they've now decided they want 50% of it to go to spouse, who's a basic rate earner, and they can absorb £20,000 of that profit, and you remain with the other £20,000 profit. Now, your 20,000 will still be taxable at the 40%. Their 20,000 will be taxable at 20%. Now, instantly, that's a £4,000 saving. So where you've gone from a liability of 16,000 just on your £40,000 property profit, you've gone down to 12,000 already. So £4,000 saving straight away. So quite material.
That single document can take a big bite out of the tax. But if you need more flexibility, or there are more than two people involved, there's a step up that lets you shape the split and plan ahead. And that is where partnerships come in.
We talk about partnerships with a lot of our clients, and these general partnerships have been around for ages. It's just something you register with HMRC. So you're still a personally held landlord who completes a self-assessment, and it could well be that you are doing it personally, but actually by creating a partnership with HMRC, and that's just registering a partnership and getting a UTR similar to how you have as a solo individual landlord, allows you to bring partners into the business, and this is really a great estate planning tool to use, because not only can you shift income in the ratio of whatever you want in that partnership, but it allows you to sort of do a bit of long-term planning, because you may want to bring children or partners into this to allow them to sort of benefit from this in the long term as well. Not enough landlords use partnerships, because they generally just buy a property sort of 50-50 and they think, well, that will do. But actually from a planning point of view, it's really good, because actually you may want to bring maybe a third person into the party here equation, or even you might want to split it in a way where actually it is genuinely, one party's doing 75-80% of the work, the other was only doing 10-20 here and there, and you want to reflect actually what's being done. But again, from a tax point of view, it's really beneficial, because the example we've already talked about here, where we've done a deed of trust 50-50, which is really common between husband and wife, you may decide, well, actually we want to do a partnership 75-25, or bring a third party, and I can do multiple calculations with 3, 4, 5 partners. But if we stick with the example we've talked about, where we've got a 50-50 deed of trust, but then actually by having a partnership, we've got the higher earner who's earning £60,000 is pretty hands-off with the managing of the portfolio, and just dabs in here and there doing a bit of work, maybe only entitled to 25% of that profit, whereas the other spouse who works part-time or doesn't work actually does most of the work in terms of the running around, tenants, work, and actually is entitled to 75% of the profits, because they do most of the work. Well, what does that mean? Well, from a tax point of view, we can then put an agreement in place to state that the partnership profits reflect that percentage, and actually have the higher earner, the £60,000 earner, in a position where they only take 25% of the profits home and 75% goes to the basic rate earner. Now, if you look at the calculations there, we're in a position where actually we can reduce the liability down to £10,000 in total from £16,000, because we've now let the basic rate earner absorb most of the profit, 75% of the profits, and the high rate earner who's paying 40 only absorb 25% of the profits. You can see where the journey's taking us in terms of the more income we're taking out of the higher earner and letting the basic rate earner absorb more of the income.
You show some sort of involvement. So like, what does that involve?
Yeah, so with partnerships, we just need to demonstrate that they are actually involved. So you can't just put like your 9-year-old child in and say they're a partner. So, because with the partnership, if HMRC ever inquire, they'll say, what's have you got an agreement? Who does what? So you need to show that actually this partner, you've got an agreement, like you've got almost like a contract, say that we do this and this partner does that.
Great. So we've used a partnership to refine who gets what and reduce the tax bill. But some portfolios belong in a company long term. And if that's the plan, there is a way to get there without the capital gains and stamp duty hit we saw earlier.
When it comes to partnerships, one of the good things you're demonstrating by doing a partnership is that you are demonstrating to HMRC that this property portfolio you're running is a business in its own right. And that's really important, because the default position HMRC have with property investment is that it's an investment type of business. It's not a trade. And when it's an investment type of business, you don't benefit from certain tax reliefs that trades do. And one of the key ones is Section 162 incorporation relief. And now that applies to any type of business which has been incorporated from a sole trader capacity to a limited company capacity. Now, by having a registered partnership being run and you showing that you've been running a partnership for, say, a few years with HMRC, you're further sort of evidencing that actually this is a business in its own right, and actually it's been running as a business in its own right, and you are sharing the profits in line with the agreement, and you are then eligible potentially for Section 162 incorporation relief. Now, what does that mean? It effectively means you can move your portfolio from your portfolio business from your personal name to a limited company and claim Section 162 incorporation relief, which effectively rolls over any gain that you may have had on the sale of those properties to your company in exchange for shares. Now, what that does do is it does kind of kick down the street the amount of capital gains you'll have to pay, and that will only inevitably be liable if you ever sell your shares. Now, the likelihood is you won't ever sell your shares because this is a long-term investment family company you're creating. You may well sell a property or some properties, which is fine. That will never trigger the capital gains. It will only be if you ever sell the shares. So it's a great way of moving your portfolio using a partnership to get it into a form where there's no capital gains tax liable. Similarly, where you claim Section 162, we claim Schedule 8 stamp duty relief as well. Now, that's another key saver, because ultimately, if we can save capital gains tax as well as stamp duty, it's a bit of a win-win. So this is certainly something you should take some advice on if you're eligible for this. And this kind of follows case law. So we follow cases that have actually gone through HMRC's tribunal cases. So we make sure that your facts and your things all kind of fall in line with what's happened historically. Some tax advisors have gone to HMRC for clearance on these things, but it is effectively a case-by-case basis. So we'll have to understand what you've been doing, how you've been running this business, and whether that applies to you.
If you want to stay sharp and never miss changes that affect your portfolio, make sure you join our newsletter. You'll get the latest property news, market insights, and tax updates straight to your inbox, so you're always one step ahead. Now we're in the company without the upfront tax pain, the next question is simple. How do we keep the company's tax low each year? One of the strongest levers is pensions paid by the company.
This is really interesting, because obviously when we're now in running a business through a limited company format, the question is, how do we minimise our exposure to corporation tax? What can we put through that will really reduce our liability? Obviously, we've gone through all this effort to kind of move into a company. How can we keep that tax exposure to a minimum? And the general rule is that anything that you've been able to claim in the past historically, the usual wholly, necessarily, exclusively things that you've claimed in the past are still allowable in a company. However, there are some extra things, I'd say you could probably claim that actually can further reduce your liability to tax. And one of the big things is pensions. And the reason I mentioned pensions is that, yes, it was also allowable and you would get your basic rate extended in your personal name and you would get some tax relief in your personal name. But as a director of a company, there's no restriction. So you could, if you and your spouse are both directors, make unlimited contributions into your pension scheme, which actually could potentially reduce your liability, your taxable profit down to zero, and pay no tax. Now, I'm not saying that's the right thing for everyone to chuck all your money into a pension scheme. As a way of background, if you are making pension contributions in your personal name, the amount you can put in tax-free is restricted to your net relevant earnings, and a maximum of £60,000 per annum. Now, in a limited company as a director, there's no restrictions and there's no cap based on your net relevant earnings. So you could be a part-time worker, or you could just be as an employed, a salary in the company on a very basic, a minimum wage of £12,570, but that does not restrict how much you put into your pension. So you could technically earn £12,500 as a director, but actually put in £40,000 into your pension scheme. Now, that's not something you could do in your personal name. So actually the benefit of that is you're taking salary out at a very basic level without any tax and national insurance, but you're making enough of a pension contribution to wipe down your corporation tax profits. And that could apply to both you and your partner, if your partner's also a director as well. So there's a potential huge saving to be had by doing some pension planning within a company.
If the company grows, that's great, but so does your estate for inheritance tax purposes. But the way you set up your shares today can protect the family tomorrow. Let's look at freezer and growth shares and how trusts can help.
When it comes to immediate tax planning, we've talked about things like pension, how we mitigate the corporation tax and what your personal tax liability looks like. But when we are using a limited company and we have a company worth hundreds, if not millions, in value, we want to make sure actually not only the short-term tax strategies are in place, some of our long-term strategies are in place as well. And that's where, limited companies do come in their own in terms of doing family planning. And when we talk about family planning, we talk about how you can protect your own inheritance tax bands between you, husband and wife, and allow your children to benefit from the growth of the company. So inheritance tax, 40% on anything over your nil rate band, which at the moment for each individual is £325,000. So you can tell that doesn't really touch the sides, in all honesty, for each individual. So inheritance tax can become a big exposure quite quickly. So trying to get grips of that earlier on in your portfolio build is really smart. It's things that you can do later on. It's things that you can do at the very beginning. But if you can keep yourself in a position where you're minimizing your 40% exposure to inheritance tax in the way your company is set up or the way your share structure is set up, then that's a further tax saving to be had on top of your kind of immediate income tax savings. I mean, the thing with inheritance tax is that a lot of the inheritance tax work we get comes from the back of financial advisors because they've gone away, or the ones who've heard about something like this and then they bring it to us. And the problem with inheritance tax is that it's not just a tax advice solution. You need to go get financial advice, really, because I could talk about the properties, but they've got a garage full of vintage cars worth 5 million. That's another exposure I'm not aware of. So it kind of it's a difficult one. We can talk about the property side and the shares and what you're worth, and it could well be that it doesn't seem like they've got an exposure, but like I said, they've got £5 million worth of car sitting at home and they've got all of a sudden got massive exposure. It's difficult to say this is what you should do, is what I'm saying. I guess there's a case of understanding, is there anything we can do to say, have you had that conversation in terms of, do you have an IHT exposure? If so, then let's bring it to the table now and we can help you in terms of going forward from the property side, because it is really we can only help you on what we're doing, and this could just be the property could be just like a small element of what your actual IHT exposure looks like.
I think when it comes to inheritance tax, the problem is some amount of time down the line, you don't know when, but often the best time to do something about it or to think about it is when you're setting the company up in the first place. So how do you set up companies with inheritance tax in mind?
We talk to clients all the time about inheritance tax. Some who really, it's like the number one priority thing that they want sorting out as soon as the company is opened. Some who have just got it in the back of their mind and they want to have a conversation about it further down. Some just don't want to have a conversation about it altogether for obvious reasons. And those ones who are more proactive about it in terms of at the point of incorporation, there's lots of things we can do, because there's things like having multiple share classes in place. And what those multiple share classes allow them to do is do a bit of IHT planning from day one, which allows them to have their own share classes. So when I say their, husband and wife, where they can have limited growth. So what we can do is we can put in a restriction in the articles, which allows their share class to grow to a value and then sort of freeze at that point. What that means is if the business becomes really successful and all of a sudden the company's worth a few £1 million in a few years because you've really done well on your portfolio build, your shares will never be worth more than a certain point that you've stipulated in your articles from day one. And the remainder of those shares will be in a child's share class or a trust that you've set up, and all that value will go there. So what that kind of does is future-proof you somewhat, because you don't know how well or not so well your portfolio build might go. But it does start you off on the right track, which allows you to say, well, actually, I've got freedom here. I don't need to worry about an IHT because actually whatever happens, my value is going to be limited to this, and any future value will go to my children. And, I'm thinking about IHT from day one. So that's a great way of potentially doing it. Now, there are obviously commercial things that you need to be impacted about having children as shareholders, what that means from a lending point of view, not giving them too much share value, what rights you give them as children. But obviously, if IHT is the big issue, then it's key that we set them up from day one. The alternative is if you don't really know what you're going to do in the future, you don't even know if you're going to have children or whether you want to give anything to your children, is to sort of maybe hold fire on those additional share classes at the beginning. You could have those share classes at the beginning, but keep them in your own name or your partner's name, but then have them in a place where you can then give them to the children or a trust in the future. Now, what that does is just gives you a bit more control right now. It means you're having to keep an eye on it somewhat, so don't let your value of your shares and your business grow too quickly without you keeping an eye on it, because it could well be that all of a sudden it's worth a couple of £1 million, and then we're dealing with a rather large IHT exposure here already in your name. Or if we do, then try shifting some of those shares to your children or grandchildren, there could already be a quite big capital gains tax exposure. So it's keeping one eye on sort of where you're headed, and then trying to do some planning in the future. And things like putting a trust in place, there are reliefs available. So if you did decide after a couple of years you wanted to put that trust in place, as opposed to putting it in place in day one, you can, and we get gift relief. So actually transferring some of your shares to a trust can be tax-free. Obviously, the costs of setting up that trust, etc., are there. But again, what we don't want to do is we don't want to do that too late when your shares have already increased in such a value that you're leaving yourself still a big exposure to tax. Those are the kind of conversations we have at the outset, and it's just really important that you know what you're getting yourself into. And there's no right and wrong answer here. Everyone has their own way of doing things, but so long as you are aware of what it may well mean in the short, medium term, then you can make an educated sort of response and kind of move to make sure you're minimizing your IHT exposure at that point.
So we've sorted the long term too. Now let's pull it all together and talk about what you should actually do next.
So I think what's come through here is that there are actually a lot more options than people realise that there are. So if you are in a situation where you've got what you think of as a tax problem, what should you be doing about it? How do you figure out what's the right thing to you? Because the right thing for you is not going to be the same as the right thing for someone else.
That's right, Rob. And it's not all doom and gloom like some people try to make out. There are always options available, and it's really important as a landlord just to remain proactive. Just as I said before, that it's important that your accountant is proactive, and there's always things that you can do to sort of review your portfolio throughout the year. Don't just do it in 31st of January or at the end of your accounting year, assuming you will know what your tax liability looks like, or you will do something. Be proactive throughout the year and stay on top of things that can be done. So things like the deed of trust, although you can't backdate it, you can still implement it halfway through a year. A partnership, if you can demonstrate that actually you've been running it as a partnership already, you could potentially backdate it to the beginning of the last tax year, and that could give you some historic savings as well. And of course, in terms of the incorporation of a limited company, you may think actually it's more expensive than you think because there are other options that we can do, and it could well be that it is an expensive option, but actually in the long term it works out as a no-brainer because actually it pays itself off within a few years. So everyone's situation is absolutely different, but I think have regular health checks of your portfolio, review it throughout the year, be proactive with what's happening in the market, and it's not all really doom and gloom. There are things that can be done, and speak to your accountant regularly.
So as you've just seen, there are plenty of legal ways to cut down, even wipe out your property tax bill. But tax planning doesn't stop here. Because while landlords are busy just trying to hold on to their rental profits, entrepreneurs are using a completely different tax hack to get rich off property. And if you want to see how it works and whether you could use it too, then watch this video next.